All right, everyone. We're jumping straight into it. No intro today. We're just going to hang out and see what happens. Just don't mind me. I'm setting up my All right, what's up, everyone? Sorry about that. I'm just letting everyone know that I'm going live. What do you guys think? I'll give you my thoughts. I want to hear you guys' thoughts first. What do you guys think is going to happen? Do you think the Fed is going to pump or dump Bitcoin today? I'm interested to see what you guys are thinking. Let me know in chat. Let me know what you guys are thinking. Let's see. Badarius Illusion, hello, how you doing? Pump the Ponzi. You think so, Polo? Let's see. Good afternoon. What do you think is going to happen? I'll give you my thoughts here in a second, Badarius. I want to hear what you guys are. I'll give you guys a little bit to come into chat, say hello. Let me know what you guys are thinking. Maybe I'll create a poll. I'll create a poll. How can I do that on here? How did I do that? Did I do that at one point? I thought I did. All right, so let's see. I don't know what's going on with this music too. Bottom of the chat window. Create poll. Oh, there it is. All right, start a poll. Let's see. All right, let's see. All right, guys, check out that poll. Let me guys know what you think. I'll go ahead and catch up here in a second. Let's see. Let's see. I think it's going to pump. I really wanted to dump, hoping to dump back to 20k-ish. Alif, how you doing, my friend? Matthew White, Sky Knight, how you doing? How's everyone doing? Paul, good to see you. Polo, 32k tonight. Entered XRP short. Let's see. Alif, what trades are you in, Johnny? What is the stop loss on XRP? Paul, I'm not sure what you are going to use. I personally use 3% on everything. I don't think I entered that XRP trade. I'm thinking about it. take a look. Yeah, I didn't enter. I said I was going to. I don't know if I'm going to because I already have a lot of shorts open. I'll go ahead and put on the. Show you guys what trades I'm in. Oh, we doing it? Yeah, these are trades I'm in. LTC short, BNB short. I'm about to enter at each short. So for me, I'm kind of spreading myself too thin. The XRP short is a good position, but just be personally, Paul, I'm not taking it. All right, let's check the polls here. Check the polls. All right, so it shows that 57% of you said dump it. 43% said pump. All right, so I'll give you guys my thoughts and expectations. I personally think you have to think of it like this. There's three case scenarios. All right, one of them. Let me turn my volume down, my music. One of the cases is that we're already expecting a certain percentage. I forgot what the percentage was, but they're already pricing in what they're expecting, right? So you got to think of what are the outcomes of what could be happening. One is that we get exactly as we expected. If that's the case, we can be bullish. If Jerome Powell decides to put a pause on raising interest rates, that's going to shoot markets through the roof. But if he goes ahead and increases interest rates higher than the expected percentage, no bueno for assets. So out of the out of those three options, there's two of them that ultimately lead to a potential push to the upside. I don't necessarily think it's going to be a big one, to be honest, because it's just based on the charts and what I'm seeing. This is just one continuous trend, guys. Like yes, you can absolutely say that we're in some sort of like wedge pattern here. I don't look at wedge patterns anymore, but absolutely can make a case for it. So I've seen these happen. I've seen these patterns play out where this is a bearish pattern and we just pump straight through it anyway. So I think the odds of us going higher, I think depending on the expectations of what's going to happen, or not expectations, what people are expecting, I think are going to be a lot higher. But I think if Jerome Powell just comes out of the woodwork out of nowhere and says, you know what, screw you guys, we're going to pump the interest rates even higher than 25 basis points, we might be in some trouble here. Well, I mean, for us, we might be in a good position, but that's my opinion. Let's see. I only drink on weekends, a leaf. As long as majority wants to short, we will pump. Yeah, that's definitely a good argument as well, Polo. Mr. Johnny, how are you? I'm done solving a problem that I have. I'm back to the business and just noticed a big pump in XRP. Crazy business in the crypto world. You missed the contracts. I mentioned this in the group. I don't know if you got in on this trade. But I actually took that XRP. I don't take XRP positions too often, but what I do, we're up 350%. So we're doing good on that. All right, let's go into the 5 minute. This is not our usual scheduled programming today, so we'll be a little bit of a degenerate. Look at the 5 minute. Hello, let's go, Jeff Jefferson. Good to see you, my friend. Let's see, Vlad. I think there will be a quick pump to 30K, then up to 25K. Absolutely could be possible as well. We can kind of do like a little false break. I think that's absolutely in the cards. Retest from A. Definitely possible. Increase rates. Interest rates will increase by 25 basis points. Is that confirmed, Sky Knight, or is that what they're Is that what they're expecting? When does it start? I'll pop it up on the screen. I missed a trade. My main business, my income is trading. This is my A business, my B business. I'm a lender, and my C business is general commerce. So 10 days ago, I had a problem. I got you. Man, I'm sorry you missed out on that trade, man. My B business, I stopped trading, stopped everything, just focus and solve that problem. Gotcha. Joe, what's up, man? How you doing? 2:30 Eastern for the press meeting. Okay, but do they release the news ahead of time? There's an 80% chance. I think the market thinks they will go by 25 basis points. It's rarely wrong. It's possible, Sky. I wouldn't surprise me. It wouldn't surprise me. It'd be definitely a blindside hit if something different happens. I agree with you on that, but you never say never. That's what I always say. Never say never. So I have to take in a car. Now I'm selling it, but yes, I already saw. Now checking the charts. I'll take a look at XRP if you want, my friend. Since you've been out of here for a little bit, I'll give you a little recap. So at the moment, we are sitting in an XRP long from this position. I don't know if you caught that in the Discord, but I got in around 36.10. 36.08 was my entry. Where is the color? All right, and then from there, we do have a possible reversal playing out. Let's see. How many hours till the Fed meeting? We have about 1 hour from now. 1 hour. Yes, your trade was perfect. Yeah, so we're still holding on to that. We have a possibility of putting in a much larger reversal. Something like this. Oh, I accidentally double clicked. We absolutely could put it something like this. That's a possibility as well. The problem is when I see XRP, we can have a small pullback or a deeper pullback. Both scenarios and in both scenarios and keep going up. It's possible contracts, but I think a larger perspective on this is that we put in an ABC here, and we're kind of teetering on that line right now. So we'll see how it behaves, but you know, we're kind of in important territory right now. 32 minutes in the numbers, 1 hour. Okay, so the releasing the numbers at 2 o'clock, and then 2:30 is going to be the news. Okay. I'll preemptively pull up. I'm going to leave Bloomberg on in the back. If I hear anything or see anything on the screen, I'll pop it up back in the chat. I'll pop it up on the screen for you guys to see. Let's see. Coin has a good potential ABC short forming, and so far so good on AVAX long. Take a look at AVAX first. Okay, yeah, off of that pivot, off of this one. We'll see if it holds. And then what was it, coin? Yes, it does have a nice ABC. So in these type of situations, this is what I would do. All right. When it comes to, I don't day trade stocks. All right. And I don't recommend you guys do it either. I really don't recommend you guys do it. My opinion, crypto's, how do I say this? Crypto is better in my opinion in general, but we do have an ABC short setup. This is how I would approach this. Is what you do is basically you let this ABC play out. All right, if you're buying shares or if you have shares, sell once price gets back below that pivot. Not financial advice. This is how I handle my short setups when it comes to stocks. All right, so I would sell once price gets back below here. And basically what I would do is if I have like an extended stop loss, let's say if I have like a 15-10% stop loss, right? If that stop loss gets hit, I buy back into the stock. All right, at that stop loss region, and then repeat the process. That's if you're looking to trade something like this. I don't use any sort of leverage when it comes to stocks. The leverage regulations in the US are absolutely stupid. It'll cost you an arm and a leg if you're wrong. So tread lightly when it comes to stuff like that. Absolutely do not over risk. Do not play with margin. Do not play with anything like that. Let's see. Okay. Do you think ABC can be better if we go up to 55 cents, bigger ABC for reverse? Yes, definitely. It's possible. It's possible contracts, but you have to take it one level at a time. All right. I know what you mean. Like if I go to an 8-hour. Yes, it's absolutely possible, but like I said, you have to take it one level at a time. You can't just assume that price is going to go up and test this region. If price can absolutely reverse from this pivot. So you kind of have to play the games of you kind of have to play the opportunities and the available options of what could be going into play or what could be playing out. You just can't be too set on one particular idea. You have to be open to multiple ideas. But yes, you're absolutely right. It is possible. But until we get a higher push up there, this could be a higher probability trade as well. Don't just expect things to go a certain way. You never know what the market's going to do. Like I said, I got the news up on a different screen. Let's see what the DXY is doing. DXY is going to be important too. What I'm probably going to do once the Fed news comes out is I'm going to leave BTC and the DXY next to each other, and we're going to see what happens on a smaller time frame. Would you show us what setup you would need to occur for to take profit on XRP? Absolutely. Let's see. I traded the present in my system. I got GD, GC, green dot, green candles. That is the initial thing in my setup. With that, I could be a president all the time. I like to see candle. I'm like, I got you contracts. Let's see. Yeah, I can show you. So, Joe, in order for me to take profit on that setup, I'm going to need some sort of larger, to be honest, if we put in an ABC here, like if we do something like this, I'm probably not going to take it because the entry's right there anyway. It doesn't make sense. I'll just hold it. But one of the things I will do is if we pump extensively higher, so let's say we just go up to like this region here. All right, and then we put in an ABC, then I'll go ahead and take it. But to me, it has to be a greater pump. I'm just not going to do it as soon as we pull back here. I need to see a higher, separation, not higher separation, a more extended price movement in my favorite direction in order for me to consider that. You guys, when time comes, I will put up the news. I'll shut up. Well, I'll stop the music and we'll go ahead and just watch. You know, this is more of a watch party. Namaste. Hi, Johnny. Good to see you, my friend. How you doing? Thank you so much for stopping by. We're just hanging out today. I know I don't usually stream today, but I figured, if interesting news is going on, We've been consolidating in this pattern for a while. We're probably most likely waiting for this news to come out. So figure why not hang out here and see what happens. Watch the chaos unfold. But let's be honest, the macro perspective, the world economics are still bad. So because of this, it should be 0.5. Banks are, let's see, a phenomenon of the last few weeks or so. Compromise would be 25. Yeah, but you have to like, if the Fed knows if they overreach and raise interest rates more or higher than what's expected, it's going to cause basically a snowball effect. And it could possibly collapse the world's economy. At some point, I think it is more than likely, I'm not saying going to happen, but it's possible it could happen in the near future. It's gonna get to the point to where the Fed's gonna have to pick. Either it's gonna pick the holding up the value of the dollar, making sure that the dollar is still valuable, or going to the banks, bailing them out. And it's 2008 all over again. But I don't personally think, to be honest, if I had to pick, I honestly have a hard time believing that the Fed will do it again. We could be wrong though. What if all this time we were just, bearish, got banks get bailed out, or something happens to where it just causes more upside? You also have to think too is that the government is going to do its best to push this off as much as it can. And technically, the government can do this forever. Now this is my opinion. Don't quote me. Like I said, I'm not an expert at this. This was my opinion. I heard this somewhere else, and I think it really resonates well. And I think this is something most people don't think about. People keep thinking about how the government is putting itself in this worse and worse situation every day. One of the things I like to think about too is that yes, inflation is getting worse, sporadically, consistently. I mean, more consistently. Sorry, I don't want to sporadically. Inflation is getting worse consistently, day over day, month over month, year over year. But you also understand too, humans are, how do I say this? People are evolving. Technology is evolving. Industries are evolving. There's going to be places for this money to go to. So for me, it's not like the inflation, everything's going up, and then basically, how do I say this? Society, I don't know I'm not an expert at this, so it's hard for me to go ahead and explain this. Basically, what I'm trying to say is, us as humans, us as a total world global system, are evolving. The technology we have is evolving. Healthcare is evolving. A lot of things are evolving. And so basically the money is being circulated into these evolving industries. So for me, it doesn't seem as bad as a face value. Like I said, this is just my opinion. I'm not an expert at this. I know I'm probably gonna get yelled at. But that's kind of my thing is, it's if we were stagnant, if we weren't evolving, we weren't progressing at all as a society, and we just kept stacking on debt, yes, I would say there's a little bit more of like a tipping point. But because we're constantly evolving, money's being recirculated into things, into new technology, I think it's not as bad as everyone thinks it is. That's my tinfoil hat conspiracy. Not really tinfoil hat, but that's just my thoughts on everything. Don't shoot the messenger. Let's see. That's right, but it's shocking to see the Feds didn't realize earlier. Yeah, but you gotta understand, these guys are a bunch of boomers. They don't understand the long-term effects of doing stuff like this. So I think eventually it will catch up to itself, but I don't think it's gonna be as bad as people might say, or the government will just keep kicking the can and just keep pushing it back. History will repeat. Absolutely, Vidarius. I think I agree. I think at some point it's gonna catch up to it, but I think the government's gonna do it as much as it can to go ahead and push that back, postpone it. Do you find that price often bounces off the previous B wave, or could it be an advantageous plan for that by taking a trade with less risk on the first bounce? Bounce off the B. What do you mean by that, Joe? Do you find that price often bounces off the previous B wave? Oh, when it's like reversing? Stupid cables, man. Sorry. Like on XRP. Previous B waves. We have an XRP short period. Joe, I'm trying to... You mean off of the previous A? Like come back down, retest it? This one here? Yeah, it's possible. Some people call this a breakout, retest of support, and a confirmation. That's definitely possible. But like I said, we don't view things that way. Remember, people are either buying the breakout or buying the retest. They're gonna, if big money is going to push this down, now's the time to do it while people are buying in. If that makes sense. Because what's happening now is basically money's being pushed out of XRP. More buyers are coming in on the retest. We'll have to see how the reaction is. Would it be beneficial to plan for the bounce off support and adjust risk accordingly? Joe, you just don't know how it's going to react. That's the thing. If you want to experiment with that, you can. You know, maybe use half risk on the first attempt, and then if we get a bounce, you won't lose as much. But for me personally, I find it that sorry, something just popped up on the screen. I want to make sure I didn't miss anything. For me, it's you just don't know. You could try, Joe. You can try, but me personally, I've seen both case scenarios. I've seen points to where we entered, it'll stop us out, and then go ahead and continue the push down, or I've also seen scenarios where it just goes straight through it and not give you a second chance. Sorry, I'm answering my group chat here. Right on. I apologize. That was confusing, but thanks for the info. I'm going to keep thinking of better ways. Hey Joe, if you want to experiment, man, let me know. If you experiment and you figure out something good, run it by me. I'll let you know what I think of it. Maybe I'll try it out. But stuff like this is going to take serious testing. You just can't test it on one or two setups. You're going to have to test it for multiple months. So, and you can use me to compare it to. If I find something good, I'll become a streamer. Huh? Why not? Why not? You guys can do this. We need more ABC traders out here. Well, actually, no, it's more competition for me, but I really don't consider it competition. It's more like companionship. Like we offer, each of us offers its own unique perspective. You know, you might see me doing things a little bit differently than Kite. David Tech also has used this. David Tech has approached the ABC strategy in a different direction as well. I think it's all beneficial. I think it's good to see different perspectives. So definitely, I encourage people to do, if they want to talk about it on YouTube, go for it. It's a tough grind though, guys. It is a tough grind. It's crazy to think. I see channels that blow up way faster than mine has, and it's just crazy to see. I'm like, how is this possible? I want to see. There's someone else that I watch, or there's someone else that I came up that I've been like kind of comparing myself to. And guys, like I said, it's not a competition. I think we can all benefit. I'm so close. I'm catching up to this guy. Fuck. Let's see. We got 1.52. I have 0.47. Let me change this music. No way I step on your toes, brother. You're not stepping on my toes. It's not, like I said, it's not, in a way it's competition, but it's not. You know what I mean? We each have our own different perspectives. And I think people bring different views to the table. People bring different ideas, different perspectives to the table. There's nothing wrong with that. Let's see. 3 weeks ago, I was bearish. Now I don't know what could bring Bitcoin down. Although I hate how they screw with my emotions. I get that, Crypto Beehive, but you can't, like I said, this is why I try to say never, ever, ever, ever stick to a strict directional bias. All right. Even if charts are showing you bearish indicators, bearish signs, always try to think of both sides of the coin. This is exactly what I was going through back in this. What you're feeling right now, Crypto Beehive, is the exact same thing I went through in this price action here. For me, I was looking at this as a larger A to a B to a C. Wherever I wanted to go ahead and put the B, I was thinking of something like that. All right, and in my head, I was like, there's no way price can keep going up. And it wasn't until we got like to this pullback here that I was like, all right, you know, it probably have a higher chance of going up to this region. But I was so dead set on this. I tried shorting every single top, even all the way up here. It just didn't work. So you gotta be open-minded. You can't be too keen on one certain direction. Try to play both sides of the coin as much as you can. That's probably the best. Oh, it's not financial advice, but it's the best advice to kind of approach your mindset. Currently learning that. Yeah, it'll take time, it'll take practice. I think if you guys read the books as well, if you guys don't know what books I'm talking about, Trading Zone by Mark Douglas and Best Losers Win by Tom Hugard. For some reason I couldn't remember his last name. Let's see. Johnny, you watch CF. Would this be a Chinese trophy? Dude, the names that the names he comes up with for these patterns is absolutely hysterical, man. I don't know why I find it so funny. All right, we got 5 minutes. Does anybody know where to find the official like numbers that they release? If anyone can let me know. I don't know if you guys can drop links in here. I don't know if you guys are able to, but if you guys can point me in the right direction, I'll start looking it up now so I can pull up the page. Because I know, like I said, they drop the news first and then the meeting comes. If we look at the bigger picture, would you enter a short if we get a new all-time high? So entering at the current top? No, it's too small. It's too small for me. And this to me looks like one continuous trend. If we put in something like this, where we dump and then come back up, maybe. But right now it's just too small. Oh, you talking about the bigger, wait, if we look at the bigger picture, you enter short if we got a new all-time high, so entering at the current top. Oh, yeah. I'm sorry. Yep. See, so I get where you're coming from, Jeff Jefferson, but I'm not the biggest fan of taking. Now, guys, I know I say zoom out. This is zooming out a little bit too much, in my opinion. If I go to like the index chart. It's just gonna wall these lines. You know what I mean? Like, how often does price ever put in a completed ABC rejection pattern? It just never did here. We rejected a little bit, pumped straight through. Same thing here. We kind of danced around this region, but pumped straight through it. I don't think that's the best trade in my opinion. Just because Bitcoin is, I know it says it's never have, but like on a major scale like this with a multiple year difference in testing all-time highs, it just doesn't seem like it really wants to go ahead and do that, reject off of there. Maybe if we, I don't know, I just don't see that being a massive, a big play in my opinion, but I can be completely wrong. Just going based off previous history, it seems like it's never put a serious rejection in when crossing above the all-time high. It just kind of consolidated, blew straight through it. Here's another ABC top position. This continue to pump straight through it. Same thing with this one, continue to pump straight through it. This is just a lot. Right, where's my Discord page? Thought I had it open. Oh, I'm an idiot. Oh, let's see. All right, let's. I'm gonna try. I think logarithmic scale is not good for this thing. For this, right? Yeah, I mean, even at a log, it just doesn't. Yeah, it's just the logarithmic curve on the much higher macro time frame. It just doesn't make sense. You know, setups like this are a thing. You know, that's a big setup. Absolutely. This is a big setup. This is a big setup. So they do occur on larger time frames, but I think there's doesn't make sense to go too far in, zoom in too much. It doesn't make too much sense to try to trade the biggest macro possibility that you can come up with. That's just me personally. I think 19.8 could be potential short from all-time high 2017 run, or is that ABC completed? Joe, that's another one. That's another one that's too big. Because if you tried shorting that here, you would have got destroyed. If I leave this line here and go to like a 1 hour time frame, look at that. We came and retested it pretty damn well though. That's pretty freaking nuts. But you just would have got destroyed in this region. Short, 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 short. You would have got stopped out probably 20, 30 times. Short, 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 short. Maybe potential short. That's so weird how it came back down and tested that perfectly. All right, let me go try to find. Does anybody know where I can get the actual document? I'm on the Federal Reserve's website. I don't know where. Does anybody know where I can get? Does anybody know where I can get the official document or the official? We'll look over it together. Let's see. I guess news and events, press releases. They like to hide the numbers. I thought they always released it on the Fed's the Federal Reserve's website. Or maybe am I looking at the wrong place? The documents of I got you. Okay. Alright, so I guess we have to wait then. I'll keep my eye on Bloomberg and see what happens. I guess maybe news will get word of it first. All right, guys. I'm going to set up the 5-minute chart. Try to be a crackhead and set up a 2-minute, 1 minute. We can ask Tom Crown. We can zoom in for more action. All right, so I'm going to do this. I'm going to pull up. Oh, God damn it. I'm going to pull up. I'm going to pull up the DXY on one chart and then the BTC chart on the other side. So left is BTC, right is. All right, we're on to 1 minute. So see what happens here. I'll pop in the Tom Crown, see if maybe he knows something I don't. Oh, here we go. We're doing it, boys. We're doing it. We're doing it. Pump it. Pump it. Let's go. Ding, ding, ding. Ring the bell. DXY is falling. Look at this, guys. Let's go, folks. Let's go. Let's do it. Let's do it. Let's see how our positions are doing. DXY just fell off a freaking cliff. Let's see how we continue to behave here. Going into the 2-minute, it's officially 2 o'clock, boys. Fed news has been officially, well, I'm not sure, but released. Let's check the lot. Let's check the news. Let's check the news. See what they say. Let's see if we're behind. Yep. Fed stays the course. Hikes by 25 basis points.
Consensus of 5.1% again for the terminal rate and a slight lean to a hold for longer. The statement does acknowledge the recent bank.
Look at that.
Quote,
ABC, guys. ABC.
The statement says,
let's see how we hold. Let's see if we hold this.
In tighter credit conditions for households and businesses and to weigh on economic activity, hiring, and inflation. The extent of these effects is uncertain. In terms of the dot plot, 10 members saw 5.1% as a median terminal rate with 7 above.
Let's see how markets like this. Let's see how markets behave. This is a move we were expecting the entire time.
One of the lower ones on the dot plot. She had one of the 2 dots below 5.1%, and that's now missing. Next year, the dots see the Fed rate moving.
What the hell happened?
4.3%. That's a little higher than the 4.1% in February. 3.1% in 2025 is unchanged from the last projection. The dot forecasts for both years are highly dispersed, meaning there isn't a lot of.
There you go. Sorry about that. It was louder than usual.
After 2023, there is no change, we should mention, in the QT process. The Fed did put out its economic projections.
Quantitative tightening.
At 0.4%. That's a tick lower than in February.
Let's see how we're doing. Let's see how we're doing, guys. Come on. Hello, dump the dollar. Dump the dollar. Yep.
PCE of 3.3% by the end of the year, up 0.2. Core 3.6%.
Let's see what happens, though. You know.
2024, slower growth, higher unemployment, and a big drop in inflation to 2.5%. And finally, we should note the statement was unanimous, guys.
And the real movement comes with JP Talks. Yep, absolutely. This is just a warm up, guys. This is just a warm up.
On the Nasdaq up by about 0.7%. The initial read on this, yields lower at the front end of the curve, just north of 4% at the moment. On a 2-year, 4.01%, down 15 basis points. On a 10-year, down about 9 basis points to 351.85. I'm sure based on that, you can guess on where the euro is. Euro dollar through 108, 108.20.
Remember, guys, before J Powell even speaks, there loves to be shakeouts. Remember, there's always shakeouts going on.
Onto their website, looked at the projection material, 2023, the median dot 5.1%.
And they removed reference to ongoing increases in rates, even though they said that perhaps things were going to get a little marginally tighter. So right now, markets are reading this as dovish at a time when they still
Typo, this is the beginning of the next hour.
Potentially cut rates. So perhaps this could be a victory. Is that
I got you.
what the Fed wants to see? Is this clear?
Could be a fake out too. Absolutely, Driller. That's what I'm expecting. You know, the dollar's still falling though. Look at the dollar. Dollar's just going off. Let's see if we can go. Is there any supports on the 5-minute? Look at that though. That's insane. Hold on. I'll go back to it in a second. All right, guys. I want to talk about something. Larger perspective. All right. Remember, guys. Larger perspective.
5.1 to come up to 550. 5.1 to 550. That tells you a lot about what they think about the last 2 weeks.
This looks like a possible larger ABC setup here. If we do get a fake out on a larger scale, I personally think that we can definitely come back down, put in a reversal point, potentially look for higher. So if this is going to play out, I think possibly we're definitely going to be looking for. We're definitely going to be going towards a possible fake out here.
Well, there are a number of questions, certainly on supervision and regulation, but I think in terms of monetary policy, it's.
Should we look at the crypto casino Bing Bing? That would be fun.
Credit conditions. Is it going to tighten them significantly enough that it does the Fed's work for it, or does the Fed simply feel like they're very close to being restrictive enough to bring down inflation so they don't have to go much higher? They did put a line in the statement about the fact that we're going to see some tightening in financial conditions from the banking situation, but they said the effect is uncertain. So I don't think Jay Powell's going to be.
Why is this chart just not loading?
It's going to be more a question of which way do they lean? Is it the banking situation that causes them to back off from being a little bit more hawkish, or is it the fact that maybe they're making progress? If we hadn't had the bank thing and we got these numbers, they would have said, well, we're getting there.
Mike, just reading between the lines right now, looking at the projections, we're learning something some people think about the reaction function of this Federal Reserve. Neil Dutta of Rem.
You ever look at liquidation charts? What I have here does show liquidations, but I don't really look at specific charts for that.
That's hard to disagree with, Mike.
Dollar is dead. It's possible, Jeff Jefferson. You never know.
Don't know that I would disagree or agree with.
Go to the 3 dots and press reload start.
Dealing with a whole bunch of indicators that are backward looking and some situations where they can't model.
No, it's, you can't see it, but where I'm at, it says unable to reach Binance. Let's try the liquidations. Guys, this is a lot. All right, I gotta pull up the chart again.
The situation has changed significantly over the last 2 weeks. We've had ups and downs in the markets, obviously, but this is where we see the economy at the moment going forward. Now, is that a reaction function, or is that?
Yeah, I pretty much have the volume set almost all the way up, like three-quarters of the way up.
At this point, they're becoming preemptive in any way.
Mike, I know you've got to run. Appreciate it as always. Mike McKee breaking down that Fed decision. We got 25. Here's a headline that just crossed the Bloomberg terminal. The Nasdaq 100 has gained 20% from the December low, on pace for a...
I just paid 20 bucks for 1,000x leverage. Love those meetings. That's awesome, Arius. Good job, man. Guys, we do not promote degenerate behavior. If anything, this is a degenerate anonymous meeting. All right, we're gonna try to fix you guys. Don't be crackheads.
What I find interesting, and whether anyone responds to this, is not only do they project that rates will end 2023 at about 5.1%, but they rose the expectation for 2024 to 4.3% from 4.1%.
Nasdaq is flying.
Perhaps they have a lower bar for how.
Let's see how the SPY. Let's see how the ES is doing.
The market's not buying this. They're already seeing it well below that by the end of the year. So
yeah, ES is flying. Oh, we did it. We did. Oh, we did not have an EBT set up. Go back to BTC. I also want to check XRP as well.
Increases and replacing it with this line. Some additional policy firming may be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time, without really committing to it.
Where's
We
XRP?
don't know. And in fairness to them, no one's got a clue what the last 2 weeks means. You mentioned Neil Dutta of Renmark, who's been asking the question all week. All these estimates
Nothing too
out there
crazy.
about
I want to keep my eye on
policy,
BTC
how they
actually.
equate to hiking over the Federal Reserve. It's almost impossible to do, isn't it?
if they don't have a model, though.
No, don't do this. Just gambling. I know. Pete Arias, I'm just joking. My name is Will, and I'm a degen. most of us are degenerates, but aren't most of us degenerates? In a way, yes. But stocks pumps, cryptos pumps. I'm scared, brother. Why are you scared, man?
25 from the Federal Reserve. They hiked by 20.
Can't be scared. The market's gonna do what it's gonna do.
The S&P by half of 1%.
You know what I mean?
A rally on the 2-year.
I don't know why. I don't know why I said that.
Just a little bit, or rather we take away some.
You know, there's something you can't control.
So right now the 2-year is
I know where you're coming from, Joe, but
basis points. The 10-year
you just gotta be on the sideline, wait for this to play out. Do not be shorting this.
in the last couple of weeks.
Well, and if we do get more rate cut expectations baked into the market, because we do see rates ending January at 4.2%, right? So this is a far cry from what the projection is of the Fed. I wonder how that changes through the press conference if they start to say, look, we still have a huge inflationary problem.
Sure.
We still could move higher. We don't view this to be that material, but we are cautious and cognizant of the path that we're on.
Alongside us to weigh in, Diane Swung, Chief Economist at KPMG, Michael Gapin, Head of US Economics.
Scared for people's lives.
Dan, first to you, your take on this.
Oh yeah, no, yeah, definitely, absolutely.
I think that the Fed is basically saying we just don't know how much credit tightening is.
Imagine being on like Wall Street right now.
Do whatever is necessary to chill the economy. We just don't want to send it into a deep freeze, and that's what you're seeing there. I think the idea that we keep.
I can't even imagine being on Wall Street trying in the middle of this chaos.
To leave out there because the Fed doesn't want to look as if it's doing a U-turn quite yet, with inflation still running as hot as it is. That said, I do think there is quite a bit of tightening in the pipeline that will do the heavy lifting for the Fed, and that's yet to be seen.
What was the actual? So they increased it by 25 basis points. That's the official. I'll pull up the.
And that's what the Fed is struggling the most with at this moment in time.
Michael, your initial read, and especially this idea that they have to not drop their estimates for rates too quickly, but basically it's just a placeholder in terms of higher rates for longer.
That's right. I have a similar read. The dot plot tells you and the statement tells you they do think that they're going to get some additional policy rate tightening out of recent events. How much, they don't know. How much will depend on how successful they are at ring fencing.
Let's see. Yeah, they're going to stop. They're going to stop rate cuts when they're breaking something. That's when it gets scary. Exactly. This is the. It sucks that like we have this kind of system run by boomers that they don't understand what the hell they're doing. Imagine if the New York Stock Exchange wasn't all digital and still had the pip. Do they still have people on the floor? I thought they still had people on the floor.
To separate financial stability and price stability at the moment.
Hey yo, Forex, how you doing, my friend? Good to see you. How's it going?
Last year it was talking about equity valuations and bond valuations, and we were concerned about whether financial.
Let's see. Nice. That was pretty much priced in since SVD. I think. Yeah, the market had 25. Yep, exactly. No, the floor has been closed for like 10 years. How come I've seen videos of people on the floor? Maybe it's just like a tourist thing now. I don't know. Maybe it's just a, yeah, it's probably just a tourist thing where people just go in and like hang out and like, I could be wrong, but
the Sri Lanka bailout and talking much more aggressively about the Pakistan bailout. These are all reflections of fragilities that have been revealed in the last 2 weeks, at the same time that we know at home that we're going to see a tightening of banking conditions, a tightening of credit market conditions that are likely to hit the backbone of employment gains, and that's employment gains in firms with less than 250 employees. Those have driven
let's see,
layoffs elsewhere, high-profile layoffs in the U.S. economy. That's an important thing to keep in mind. Is
could also be a stop hunt. Absolutely, almost good, bro.
How it affects the economy and how it plays out. It's really going to hit.
Come on, man. It's a nice day. We got some chaos in the markets. Kidding. Fed raises rates 0.25% and signals it's not done in its battle against inflation. Is this bullish or bearish for crypto?
There is this line in there about additional policy firming may be appropriate.
Well, if they keep raising interest rates, it's bullish for the dollar, so it's not good for crypto. But as you can see, DXY is still dumping, but we'll see what happens. Usually you want the Fed to basically to either, well, obviously you want the markets to, or the economy to fight inflation, the US government to fight inflation, but take a look at what happened when the Fed was just printing money. Obviously the money is getting rolled into stock markets and all that, so it's artificial inflation. But yeah, I genuinely think that this should be bullish for the dollar, but you can see it's still, it's still fighting in this region after dumping a decent amount.
Well, let's talk about how the chairman handles the messaging in the news conference.
Okay, so the floor is still used, but only for very limited markets. Okay, I gotcha. That's what I thought, brother. For some reason, I saw videos, probably within the last couple months, of people still on the floor.
In 15-18 minutes time.
I heard some opinions that zero. Sorry about that. I heard some opinions that zero rates would have scared too many people away with that the markets were that weak. Perception is more important than reality. That's definitely true, Coyote. The meaning is more important than the numbers today. It's how Powell speaks. If he's hawkish still or super dovish because of bank fails. Sorry, the press conference after the meeting. Yeah, so in the next, coming up here the next 10, what was it? What time? My computer clock is ahead. The next 15 minutes.
Right now is going to be his job. Cannot afford to take a misstep. He's got to be very careful to not signal to financial markets that things are worse than anyone thinks, but also to acknowledge that they know there is some tightening in the pipeline that they may have to adjust to.
Michael, what would your question be to the chair?
Two things. Why did you declare a systemic event? Preemptive, or did you actually see something that rose to the level? And second, does a larger balance sheet through the provision...
Sorry, the press conference after the meeting. He's always says inflation is where they want it to be. Yeah, I feel like Jerome Powell has a script. Like, he can't say certain things. It's because other people know how important, or how his words fluctuate the market. So I'm sure he's just going to keep saying the same stuff over and over again, avoid certain questions. The number is kind of irrelevant now, just kind of hawkish. Yeah, exactly.
But you got it. Mike Afen, we've got to let you go. I know you've got to run. Mike Afen there, Bank of America. Thank you, Mike. Thank you as always. I think a lot of people were on the fence going into this decision, 25 or nothing. I just can't believe, Lisa, how quickly this conversation has changed in 2 weeks. We've gone from Chairman Powell in his semi-annual testimony teeing up, at least opening the door to 50.
He says what politics want to. Exactly.
The follow-through on the economic data backed it up. Backed it up. Payrolls was decent, CPI, and now we're sitting here and saying, yeah, no.
It's better to be lucky than right. We keep saying that. And how much they luck out with their 25 basis point decision to downshift 25 basis points. And now it looks genius, right? Because they could just hike by 25 basis points and seem like they're on track. I thought this was really interesting, a Deutsche Bank survey of market analysts, and they said that 86% of respondents said that the Fed will go 25 basis points. Only 53% said they should. Everyone was on the fence between nothing, possibly a 50 basis point rate hike, a 25 basis point rate cut. So here we are.
I see two camps right now. There's a group of individuals that are extrapolating out the events of the last 2 weeks, saying we're past the point of no return. Tighter lending standards are coming.
What Slimbo could call it a cascade of events. Absolutely, Scott, and I think that's definitely correct. There's a lot of weight on his shoulders, so.
It's a process. I have no idea where we
The
are.
Powell is actually doing the opposite of what politicians want right now. None of them want interest rate hikes because they all have assets.
Change this quickly in 2 weeks. Where are we a week from now? 2 weeks from now? I don't know. I don't think the committee knows either. And that's the challenge for this news conference for the chairman.
And I think that the gap between what people think that they should do and what they will do highlights that people are going to try to blame the Fed no matter what. So it's always going to be, some kind of finger pointing. But right now, the market seems to be handling this very well. And I think that seems pretty clear.
The equity move fading a little bit. We're still positive on the S&P by a tenth of 1%. On the Nasdaq up by about a half of 1%. If you check out the bond market, that move sticks. Down 10, 11 basis points at the front end on a 2-year. Right now, 4.058% on a 10-year, down 8 or 9 basis points at 352. Dollar weakness, euro strength. Euro's been gaining now for the best part of a week. Euro dollar 108.43, positive by about 0.7%. Dan Swank's still with us. With us as well now is Matt Hornback, Global Head of Macro Strategy at Morgan Stanley. Matt, you've had about 16 seconds.
Let's see. Pelosi called for Powell to resign last month, bro. Yeah, I've heard that. What time is the press conference? I wanted to go out but have too many open trades. It is in 12 minutes. It's 12 minutes. I'll put it up on the screen once it starts.
They're going to hike less, but cut later. Hike less, cut later. That's the way they've decided to balance these two concerns. And that seems like a pretty rational decision. So I think the market should feel comfortable with this. The bond market, of course, is now going to have a very difficult time taking out these rate cuts that are priced in through the balance of this year. I would not expect the market to take those rate cuts out in the near term, and it could very well price in more cuts if the data deteriorate from here.
Fed forecast is one more rate hike this year. That would be interesting, Stephen. Let's see if they actually follow through with that.
What we're talking about, this spread between what the Fed was signaling and what the market was pricing. Market was saying rate cuts, recession's coming. Then the data just pushed the market to reprice, encouraged by the communication from the Federal Reserve. Given what's developed in the last couple of weeks, it's a new risk, it's financial instability. Matt, with that in mind, how sensitive will we be to traditional indicators, CPI, payrolls, when it comes to revising those rate cuts?
Yeah, I think that investors are going to discount data that looks fine and overweight data that doesn't look fine. And so, ultimately, if you have not an unemployment claims number that prints 200,000, pretty much in line with the recent trends, people will, think, that just hasn't felt the impact of what's going to come. Versus if unemployment claims surprises to the upside by 50,000, all of a sudden investors are likely to read that.
You take a look at RSI and see we have reset the bearish divergence we had recently. Pretty pleased. Yeah. What time frame?
And there's also this question.
There's a certain time frame when we look at Coyote.
The fact that it doesn't come down as quickly as people previously thought, Diane, raises this issue of whether the market is wrong in thinking that the last 2 weeks created an environment for even tighter financial conditions.
It's still there.
Drag down growth the way that
even on a 30-minute, it's still there.
Be thinking much more than people thought.
We have bear on 4 hour and lower. Let's go to like a 2 hour.
Well, I do think that it is.
Nope. So we have a divergence here.
At this point in time, even though all the data to date has been hot and strong, we also know all the seasonal factors that have contributed to that are going to reverse at some point in time.
We have a hidden bear.
Another hot PCE number.
Hidden bearish divergence on a 2 hour, 1 hour.
I do agree.
Still hidden bear. Even when it comes to the smaller area price action, we have a hidden bear and also a bearish divergence here as well off of these highs.
And that's what the Fed is starting to look at is they're sort of looking at eroding inflation slowly. I think that's a very nice way of thinking about it. It's not.
Oh, you on a 4 hour, it's more pronounced that bearish divergence.
We're now talking about a much more of a
Remember, guys,
kind of
ball against the glass.
See out there, not a cliff event, but a much
Cross
deeper
ball
recession than the Fed would actually
or ball
desire.
against the glass. Remember,
That's the
we can
challenge
use that
with the
momentum
Fed is
to
how
get
does it
push-ups
sort of
straight to the
think
upside. Doesn't mean that it has to happen.
tightening of financial
Um,
conditions, but also
but
in allowing
we have
for
the
it
possibility
isn't
of
too much now
that
on
definitely
the other
happening.
side of it. And we want to cool the economy. The Fed's goal is not to send the economy into a deep freeze.
Listening to Diane speak, it feels like the balance of risks has shifted. Matt, I'd love you to weigh in on how the balance of risks has shifted, how significantly, and how that could be reflected today.
Well,
I think the balance of risk. Go ahead. Sorry, go ahead.
Matt, go ahead.
Yeah, so I mean, the way I see the balance of risk, they've clearly shifted to a weaker outlook for the economy. I think the Fed has acknowledged that in not so many words, but, the press conference.
All right, before this meeting starts, I'm going to go fill my water.
To give us a different spin,
Yeah,
but
I'll be right back.
nevertheless, I think the balance of risks have shifted.
I don't want to, I'm going to be drinking a lot of water, just watching what happens. Grab your popcorn, folks. Grab your popcorn.
60, 70 basis points of rate cuts by the end of the year. And, that I think tells you everything you need to know about the balance of risk this year.
Let's work through this decision. If you're just tuning in, welcome to the program. We are about 8 minutes away from a news conference with Chairman Powell. This is the Fed Decides Bloomberg Savannah special live on TV and radio with Lisa Abramowitz. I'm Jonathan Ferro. Here's your decision. It was consensus at 25. We looked for a hike. We've got one. Some people thought we'd get a pause. We didn't get that. The language in the statement was always going to be important. The language of the previous statement read something like this. The committee anticipates that ongoing increases in the target range will be appropriate. That's gone. It's been replaced with this. The committee anticipates that some additional policy firming may be appropriate, and you can take that to mean whatever you want it to mean right now. We have to look at the forecast as well. Lots of moving parts here, but I'll pick out one for you. There is the so-called median dot, year-end for 2023. At the previous meeting, or rather the previous set of projections, suggested 5.1% would be the median dot for year-end 23. That stays the same. So here's the price action in response to that. The S&P 500 positive by about 0.2%. The gains fade just a little bit. In the bond market, yields are lower at the front end of the curve, down 12 basis points. Your 2-year at the moment, just north of 4%. I know we need to frame where we've been the last month or so. So north of 5%, south of 4%, somewhere in between the high of the last month and the low of the last month. 360, I think the low. Lisa, 368-ish. The high, 5.08%.
This goes to this idea of the Fed's going to hike until something breaks. And there was this idea in the market over the past couple of weeks that something was breaking and indeed had broken. And suddenly people thought, okay, rate hike's over, start cutting. And now perhaps we found some stability. So where does that leave the inflation picture? John, the striking aspect of this is that people seem to be downgrading their longer-term view of inflation and how high the Fed's funds rate will ultimately show up. I want to hear about that from Chair Powell, his understanding what they're looking for to determine what that terminal rate looks like.
This is a financial stability shock, and people have been reflecting on the experience of the UK back in September, October time, and we discussed this earlier this morning. The difference is the underlying policy risk back in the UK was inflationary. It was fiscal authorities willing to spend a whole lot more, cut interest rates, do all of those things. It was an inflationary risk.
All right. See, bro, what do you think? Pump or dump? Sorry about that, Forex. Had to go grab a quick drink. To be honest, a lot of signs are pointing to the downside. It's really hard for me to call. So on the bigger picture, I see things going to. Oh shit.
I can't put a number on it, but I think we can coalesce around the idea of what.
On the bigger picture, I could see price going ahead and testing, that high 30K to low 40K region to put in a much larger potential ABC here.
On financial conditions, they can't put a finger on it. So then, what are they looking for?
Something like this.
Holistic data.
So we can just keep going.
Or is it something else? Is it a lending?
And actually test that these areas.
Interesting question. If we're not looking at
and maybe get a reversal set up here. But at the same time, I think we are due for a larger pullback to an actual separation in trend, not just a quick wick and back up. But if this is going to be one of those bull runs, gonna have to compare it to what happened
stronger euro, a weaker dollar, with us still.
You kind of maybe have to compare it to what happened here. I'll show you guys in a second.
History. We're always talking about history and this Fed share, not wanting to be Burns, wanting to be Volcker. I wonder what.
I mean, even this pump. I mean, this pump lasted months, multiple months. But even like that, from 3K to 14K, we had ABCs all day. This is.
Out there. I think what the
you know what I mean?
Is going to do is say how many options they have on the table.
Not the best ABCs, but they had ABC pullbacks.
We saw the short selling that pushed the treasury market.
So for me personally, I need to see something like that. I need to see at least a pullback, but we just haven't.
And I think that's very important.
We just haven't got it.
They're watching their own deposit window. They're watching bank deposits and the deposits at banks. And what does that mean for liquidity in the broader banking system? They're also looking at the international situation. They've always said they're looking at all of these things at once. Looking at all of them at once has taken on a new sort of spectrum for them, and the risks are now much more to the downside. That this is, I agree with you wholeheartedly, a much
wasn't that 3 to 14K a bull sky situation? We have a major structure above us. Kind of, but at the same time, there are still resistances on the way up. It's the same thing with this. You know, we still have resistance on the way up. I know market conditions were different, but regardless of the situation, even if we are in a more aggressive uptrend, we need to see healthy pullbacks. We just haven't gotten healthy pullbacks yet.
You've got to be worried about what you see, and I don't think the
healthy pullbacks are basically testing a certain levels of support, but putting in clear ABCs, nice break in structures, getting people to FOMO into shorts, something like that.
Well, maybe they will pause, even though we think they're going to go quarter point. And I think that's because of the uncertainty we face right now.
All right, let me go pull up Jerome Powell meeting. It's got to be starting here in a second.
He's confident that the inflation will come down. He said that he's willing to take higher unemployment. As Rich put it, well. All
right, so this is what I'm going to do. I'm going to pull this up here. I'm going to pull this window down. Let's stick it right here. Be a little bit smaller. Can I not make it any smaller? Oh, I can't. It's the smallest I can make it. That'll do. All right, and we're gonna watch the fireworks. Let me know if you guys like that setup. Shit. Oh, even if I pull that down, it's not gonna increase the window. Okay. Billy X, Hex, mother effers. I don't want to say it, but good to see if Hex get in here. I'm sorry, like I think that's the funniest name for someone who follows a certain coin, a Hexican. That's absolutely phenomenal. So good to see you, my friend. Hope you're doing well, Billy. Isn't it funny how as TA people we say news is irrelevant, but yet we are glued to the biggest news? News is irrelevant, but news does cause price fluctuations, if that makes sense. I wouldn't mind a setup. I wouldn't mind a setup for chart views, hot dog style, that hamburger. You mean like so you want me to go up and down or like this? Hamburger would be those two. Let me know if I'm right on that, Joe. So you prefer this? I prefer this too because it's more, we can see more relative price action from here. If things significantly pump or dump, I can always just zoom out. I wouldn't. So you want me to try top and bottom? What do you guys think? Should I go stick it like this or should I stick it top and bottom? It's also interesting to watch what's going on since the financial market hasn't been this crazy in 15 years. Absolutely. Oh, this is it, guys. Get your popcorn ready. Let's see what Jerome Powell has to say. I'll turn it up.
Before discussing today's meeting, let me briefly address recent developments in the banking sector.
I'm going to turn the music off.
In the past 2 weeks, serious difficulties at a small number of banks have emerged. History has shown that isolated banking problems, if left unaddressed, can undermine confidence in healthy banks and threaten the ability of the banking system as a whole to play its vital role in supporting the savings and credit needs of households and businesses. That is why, in response to these events, the Federal Reserve, working with the Treasury Department and the FDIC, took decisive actions to protect the U.S. economy.
Dude, that'd be absolutely hilarious.
In our banking system.
Screw you guys. Boom.
These actions
buy
demonstrate
Bitcoin.
that all depositors' savings and the banking system are safe. With the support of the Treasury, the Federal Reserve Board created the Bank Term Funding Program to ensure that banks that hold safe and liquid assets can, if needed, borrow reserves against those assets at par.
Pump dude needed to play with the Lambo dealer.
Our long-standing discount window is effectively meeting the unusual funding needs that some banks have faced and makes clear that ample liquidity in the system is available. Our banking system is sound and resilient with strong capital and liquidity. We will continue to closely monitor conditions in the banking system and are prepared to use all of our tools as needed to keep
Your mic is down, his up.
In addition, we are committed to learning the lessons from this episode.
I turned his up. Do you want me to turn him down a little bit?
Events like this from happening again. Turning to the broader economy and monetary policy.
I turned it down a little
Inflation
bit.
remains too high, and the labor market continues to be very tight. My colleagues and I understand the hardship that high inflation is causing.
Nah, him up.
Remain
All right.
strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. Consumer spending appears to have picked up this quarter, although some of that strength may reflect the effects of swings in the weather across the turn of the year. In contrast, activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Committee participants generally expect subdued growth to continue. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.4% this year and 1.2% next year, well below the median estimate of the longer-run normal growth rate. And nearly all participants see the risks to GDP growth as weighted to the downside. Yet the labor market remains extremely tight. Job gains have picked up in recent months, with employment rising by an average of 351,000 jobs per month over the last 3 months. The unemployment rate remained low in February at 3.6%. The labor force participation rate has edged up in recent months, and wage growth has shown some signs of easing. However, with job vacancies still very high, labor demand substantially exceeds the supply of available workers. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median unemployment rate projection in the SEP rises to 4.5% at the end of this year and 4.6% at the end of next year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in January, total PCE prices rose 5.4%, excluding the volatile food and energy categories. Excluding those, core PCE prices rose 4.7%. In February, the 12-month change in the CPI came in at 6%, and the change in the core CPI was 5.5%. Inflation has moderated somewhat since the middle of last year, but the strength of these recent readings indicates that inflation pressures continue to run high. The median projection in the SEP for total PCE inflation is 3.3% for this year, 2.5% next year, and 2.1% in 2025. The process of getting inflation back down to 2% has a long way to go, and is likely to be bumpy. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a 1/4 percentage point, bringing the target range to 4 3/4 to 5%. And we are continuing the process of significantly reducing our securities holdings. Since our previous FOMC meeting, economic indicators have generally come in stronger than expected, demonstrating greater momentum in economic activity and inflation. We believe, however, that events in the banking system over the past 2 weeks are likely to result in tighter credit conditions for households and businesses, which would in turn affect economic outcomes. It is too soon to determine the extent of these effects, and therefore too soon to tell how monetary policy should respond. As a result, we no longer state that we anticipate that ongoing rate increases will be appropriate to quell inflation. Instead, we now anticipate that some additional policy firming may be appropriate. We will closely monitor incoming data and carefully assess the actual and expected effects of tighter credit conditions on economic activity, the labor market, and inflation. And our policy decisions will reflect that assessment. In our SEP, each FOMC participant wrote down an appropriate path for the federal funds rate based on what that participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year, 4.3% at the end of 2024, and 3.1% at the end of 2025. These are little changed from our December projections, reflecting offsetting factors. These projections are not a committee decision or plan. If the economy does not evolve as projected, the path for policy will adjust as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation. We remain committed to bringing inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening in labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
You, Colby Smith with the Financial Times. How confident is the committee that the recent stress that we've seen and you've alluded to is
Do the questions even matter?
And that deposit flight among mid-sized lenders in particular.
Let me guys know in chat. Do the questions matter?
So,
if it does, I'll shut up.
I guess our view is that the banking system is sound and it's resilient. It's got strong capital and liquidity. We took powerful actions with Treasury and the FDIC, which demonstrate that all depositors' savings are safe and that the banking system is safe. Deposit flows in the banking system have stabilized over the last week. And the last thing I'll say is that we're undertaking a thorough internal review that will identify where we can strengthen supervision and regulation.
I'll be quiet.
Just a quick follow-up. I mean, given all of the stress and the uncertainty that you've also alluded to in the statement, how seriously was a pause considered for this meeting?
So we did consider that in the days running up to the meeting. And you see the decision that we made, which I'll say a couple things about. First, it was supported by a very strong consensus, and I'll be happy to explain why. And really it is that the intermeeting data on inflation and the labor market came in stronger than expected, and really before the recent events, we were clearly on track to continue with ongoing rate hikes. In fact, as of a couple of weeks ago, it looked like we'd need to raise rates over the course of the year, more than we'd expected at the time of the SCP in December, the time of the December meeting. We are committed to restoring price stability, and all of the evidence says that the public has confidence that we will do so, that we'll bring inflation down to 2% over time. It is important that we sustain that confidence with our actions as well as our words. So we also assess, as I mentioned, that the events of the last 2 weeks are likely to result in some tightening of credit conditions for households and businesses, and thereby weigh on demand, on the labor market, and on inflation. Such a tightening in financial conditions would work in the same direction as rate tightening. In principle, as a matter of fact, you can think of it as being the equivalent of a rate hike, or perhaps more than that. Of course, it's not possible to make that assessment today with any precision whatsoever. So our decision was to move ahead with a 25 basis point hike and to change our guidance, as I mentioned, from ongoing hikes to some additional hikes maybe, some policy firming may be appropriate. So going forward, as I mentioned, in assessing the need for further hikes, we'll be focused, as always, on the incoming data and the evolving outlook, and in particular on our assessment of the actual and expected effects of credit tightening.
Mr. Chairman, can you explain the difference between ongoing rate increases and firming? Does firming imply a rate increase per se, or could policy firm without you increasing rates?
No, I think it's meant to refer to our policy rate. Really, I would focus on the words may and some, as opposed to ongoing. So we clearly were, what we were doing there was taking on board trying to reflect the uncertainty about what will happen. I mean, it's possible that this will turn out to have very modest effects. These events will turn out to be very, very modest effects on the economy, in which case, and inflation will continue to be strong, in which case, the path will might look different. It's also possible that this potential tightening will contribute significant tightening in credit conditions over time, and in principle, if that means that monetary policy may have less work to do. We simply don't know.
Do you have concerns that the hike you did today could further exacerbate the problem in the banks?
No, I mean, with our monetary policy, we're really focused on macroeconomic outcomes. In particular, we're focused on this potential credit tightening and what can that produce in the way of tighter credit conditions. I think when we think about the situation in the banks, we're focused on our financial stability tools, in particular our lending facilities, the discount window, and also the new facility.
Nick Timmeros of the Wall Street Journal. Chair Powell, in your testimony 2 weeks ago, you had indicated you thought the terminal rate would be higher. Obviously, that was before the stress in the banking sector. And I realize there's a lot of uncertainty, but can you explain at all to what extent your forecasts or those of your colleagues or those of the board staff incorporated today a material tightening of credit availability because of the stress in the banking sector, or are you waiting to see it in the data before you incorporate that potential tightening into your forecasts?
So, we've just come from an FOMC meeting, and the people who write the minutes will be very carefully counting, but I'll tell you what I heard. What I heard was a significant number of people saying that they anticipated there would be some tightening of credit conditions, and that would really have the same effects as our policies do, and that therefore they were including that in their assessment, and that if that turned out not to be the case, that in principle you'd need more rate hikes. So some people did reflect that in their SCP forecasts. I think there may also just have been, remember, this is 12 days ago. We're trying to assess something that just is so recent, and it's very difficult. There's so much uncertainty. So December was a good place to start, and we wound up with very similar outcomes for December. And in a way, the data in the first part, the first 5 weeks of the intermeeting period, pointed to stronger inflation and stronger labor market. So that pointed to higher rates, and then this latter part, kind of the possibility of credit conditions tightening, really offset that effectively.
To follow up, have you considered at all whether your primary tool, the funds rate, is going to be enough to sustain the kind of tighter financial conditions that you believe will be necessary without doing significant damage to the banking sector? Have you, for example, considered changing reserve requirements, selling assets out of the system, open market account, as a way to better achieve tighter financial conditions that don't accelerate deposit erosion, for example, from banks?
You know, we know that we have other tools in effect, but no, we think our monetary policy tool works, and we think, you know, many banks, our rate hikes were well telegraphed to the market, and many banks have managed to handle them.
Hi, Victoria Guida with Politico. I wanted to ask, you, along with the FDIC and the Treasury, the Fed Board decided to invoke the systemic risk exception to allow uninsured depositors to be protected at these two banks. And I was just wondering if you could speak to why that decision was made. Was it purely a confidence issue, or was there a concern that there would be some sort of economic contagion or financial contagion from the failure of these banks?
The issue was really not about those specific banks, but about the risk of a contagion to other banks and to the financial markets more broadly. That was the issue.
Okay, and then can you also, just to follow up, can you speak to the role that you will be playing in the Fed's internal investigation on its supervision and regulation? So
Vice Chair Barr is of course leading that review, and he's responsible for it in his capacity as Vice Chair for Supervision. I realized, you know, right away that there was going to be a need for a review. I mean, the question we were all asking ourselves over that first weekend was, how did this happen? And what we did was early Monday morning we sat down and said, let's do this, and he was obviously going to lead it in his capacity. So I don't, you know, my role was to announce it, and I get briefed on it, but I'm not involved in the work of it.
Hi, Chair Powell. Howard Schneider from Reuters. So I want to go back to your February press conference. You mentioned the word disinflation, I believe, 9 or 10 times, a process that you felt was, I forget the word you used, but gratefully underway or something like that. Is disinflation still occurring in the U.S. today?
Yes. I mean, what actually happened, Howard, was I got the question 12 times. So maybe it's a feature, not a bug. But but yeah, absolutely absolutely the same. The story is intact. So it's really three parts, right? Goods inflation's been coming down now for 6 months. It's proceeding more slowly than we would have liked, but it's certainly proceeding. Housing services is really a matter of time passing. We continue to see the new leases being signed at much lower levels of inflation. So that's 44% of the core PCE index, where you've got a story that's ongoing. Where we didn't have in February, and we still don't have now, is a sign of progress in the non-housing services sector, and that is, you know, that's just something that will have to come through softening demand, and perhaps some softening in labor market conditions. We don't see that yet, and that's of course 56% of the index. So the story is pretty much the same. I will say that the inflation data that we got, to your point, really pointed to stronger inflation.
If I could follow up on that, I was curious why you don't see more coming from the credit crunch, because it seems to me that's something that you'd actually welcome to a degree and expect. And are you not seeing more coming from that because you don't know, or because you just don't want to have another round of wishful thinking?
So it's really just a question of not knowing at this point. There's a great deal of literature on the connection between tighter credit conditions, economic activity, hiring, and inflation. Very large body of literature. The question is, how significant will this credit tightening be, and how sustained will it be? That's the issue, and we don't really see it yet. It's so people are making estimates. You know, people are publishing estimates, and it's very kind of rule of thumb guesswork almost at this point. But we think it's potentially quite real, and that argues for, you know, being alert as we go forward, as we think about further rate hikes. For us, we'll be paying attention to the actual and expected effects from that.
Gina. Hi, Chair Powell. Gina Smilik from the New York Times. Thank you for taking our questions.
I wonder if you could talk a little bit, I know that you've got your internal review coming, but I wonder if you could talk a little bit about what you think happened with oversight at Silicon Valley Bank and whether this suggests that something about regulation and supervision needs to actually change going forward. And I wonder, how can the American people have confidence that there aren't other weaknesses out there in the banking system, given that this one got missed, as you noted?
So let me say what I think happened, and then I'll come to the questions around supervision. So at a basic level, Silicon Valley Bank management failed badly. They grew the bank very quickly. They exposed the bank to significant liquidity risk and interest rate risk, didn't hedge that risk. We now know that supervisors saw these risks and intervened. We know that the public saw all this. We know that SVB experienced an unprecedentedly rapid and massive bank run. So this is a very large group of connected depositors, concentrated group of connected depositors, and a very, very fast run, faster than the historical record would suggest. So as for us, so for our part, we're doing a review of supervision and regulation. My only interest is that we identify what went wrong here. How did this happen is the question. What went wrong? Try to find that. We will find that. And then make an assessment of what are the right policies to put in place so that it doesn't happen again, and then implement those policies. It would be inappropriate for me at this stage to offer my views on what the answers might be. I simply can't do that. Vice Chair Barr is leading this, and I think he's testifying next week, so, but that will be up to him. So that's really where it is. The review is going to be thorough and transparent. It is clear, to your last question, it's clear that we do need to strengthen supervision and regulation. And I assume that there will be recommendations coming out of the report, and I plan on supporting them and supporting their implementation.
Sorry, and the final point, can we feel confident that these weaknesses don't exist elsewhere, given that they got missed at this bank?
These are not weaknesses that are at all broadly through the banking system. This was a bank that was an outlier in terms of both its percentage of uninsured deposits and in terms of its holdings of duration risk. And again, supervisors did get in there, and they were, as you know, obviously, they were on this issue, but nonetheless, this still happened. And so that's really the nature of the of the review, is to discover that.
Michael McKee from Bloomberg Radio and Television. You've been very consistent in saying that the Fed would be raising interest rates and then holding them there for quite some time. Following today's decision, the markets have now priced in one more increase in May, and then every meeting the rest of this year, they're pricing in rate cuts. Are they getting this totally wrong from the Fed, or is there something different about the way you're looking at it, given that you're now thinking that moves might be appropriate as opposed to ongoing?
So we published an SEP today, as you will have seen, and it shows that basically participants expect relatively slow growth, a gradual rebalancing of supply and demand in the labor market, with inflation moving down gradually. In that most likely case, if that happens, participants don't see rate cuts this year. They just don't. I would just say, as always, the path of the economy is uncertain, and policy is going to reflect what actually happens rather than what we write down in the SEP. But that's not our baseline expectation.
Well, if I could follow up and ask, as you look forward into the rest of the year here, are you saying that what you see and the 5.1% basically consensus is based on it will be sufficiently restrictive, or is it leavened by the idea of you don't know what's going to happen? In other words, what should people think about in terms of how the Fed thinks about how far it is from the terminal?
It's going to depend. Remember, we're looking, for purposes of our monetary policy tool, we're looking at what's happening among the banks and asking, is there going to be some tightening in credit conditions? And then we're thinking about that as effectively doing the same thing that rate hikes do. So in a way, that substitutes for rate hikes. So the key is we have to have policies got to be tight enough to bring inflation down to 2% over time. It doesn't all have to come from rate hikes. It can come from tighter credit conditions. So that we're looking at, and it's highly uncertain how long this situation will be sustained or how significant any of those effects would be. So we're just going to have to watch. In the meantime, and obviously at the end of the day, we will do enough to bring inflation down to 2%. No one should doubt that.
Let's go to Rachel Siegel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. I know we've talked a bit about how Silicon Valley Bank was unique to a certain sector of the economy, but there's also growing concern that there are financial stability risks from the commercial real estate market and loans that will begin to roll over later this year and next, and that smaller regional banks also disproportionately hold those loans. Is there a risk that could mimic the kind of what we saw with SVB to banks that disproportionately are focused in commercial real estate?
So, we've well aware of the concentrations people have in commercial real estate. I really don't think it's comparable to this. The banking system is strong, it is sound, it is resilient, it's well capitalized, and I really don't see that as at all analogous to this.
And one other question, would you be open to an independent investigation separate from the Fed's probe?
I welcome. It's 100% certainty that there will be independent investigations and outside investigations and all that. So we welcome, when a bank fails, there are investigations, and of course, we welcome that.
Edward.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. Inflation has been rather sticky, so do you need help from the fiscal side to get inflation down faster?
We don't assume that. We don't give advice to the fiscal authorities, and we assume that we take fiscal policy as it comes to our front door, stick it in our model along with a million other things, and we have responsibility for price stability. The Federal Reserve has responsibility for that, and nothing is going to change that. So we will get inflation down to 2% in time.
And if I can follow on that, but they're working, the spending that's happened is working against what you are doing, right? So it's prolonging inflation?
If you have to look at the impulse from spending, because spending was, of course, tremendously high during the pandemic, and then as the pandemic programs rolled off, spending actually came down. So the sort of fiscal impulse is actually not what's driving inflation right now. It was at the beginning perhaps part of what was driving inflation, but that's not really the story now.
Let's go to Neil Irwin.
Hi, Chair Powell. Neil Irwin with Axios. Two questions about aspects of the government's response on Silicon Valley Bank 2 weekends ago. First, why is this new bank funding facility done under Emergency 13.3 authority as opposed to expansion of the discount window, changing the terms of the discount window that's been around a long time? And second, can you discuss the Fed's role in the FDIC guarantee of uninsured depositors and why there's $143 billion on your balance sheet last week supporting that deposit guarantee?
Sure. So 13.3 seemed like the right, we have a little more flexibility under Section 13.3. We've done quite a lot under the discount window as well. We needed to do a special facility that was designed a certain way, so we did it under 13.3. Really no magic to that. It's only available in unusual and exigent circumstances, and it has to meet certain requirements, but it seemed to be the right place. So with the FDIC, we're lending to the, in effect, we're lending to the bridge bank. So that's where the funds came from, and it's a loan that's 100% guaranteed by the FDIC, so there's no risk in it for us.
Chris Rugaber.
Thank you, Chris Rugaber at Associated Press. The SEP suggests one more rate hike, as does the change in the language in the statement, in which suggests that you're perhaps nearing the end of a cycle of rate hikes. Do you feel, though, that if inflation remains high, you'll be able to resume additional hikes as needed, or have you somewhat tied your hands here with these signals about rate hikes coming to an end? Thank you.
No, absolutely not. No, if we need to raise rates higher, we will. I think for now, though, as I've mentioned, we see the likelihood of credit tightening. We know that can have an effect on the macroeconomy, on demand, on labor market, on inflation, and we're going to be watching to see what that is. And we'll also be watching what's happening with inflation and in the labor market. So we'll be watching all those things, and of course we will eventually get to tight enough policy to bring inflation down to 2%. We'll find ourselves at that place.
Kyle.
Hi, Chair Powell. Thanks for taking the question. Kyle Campbell with American Banker. I have a couple questions about the balance sheet. First of all, I'm curious at what point the financial supports that the Fed is extending through the discount window and through its enhanced lending facility might be at odds with the objective of reducing the balance sheet. And I'm also curious what your thoughts are on not just the availability of reserves, but the distribution of them throughout the banking system, and at what point you might be concerned about it being scarce for certain banks.
So, so people think of QE and QT in different ways. So let me be clear about how I'm thinking about these recent developments. So the recent liquidity provision that has increased the size of our balance sheet, but the intent and the effects of it are very different from when we expand our balance sheet through purchases of longer-term securities. Large-scale purchases of long-term securities are really meant to alter the stance of policy by pushing up the price and down the rates, longer-term rates, which supports demand through channels we understand fairly well. The balance sheet expansion is really temporary lending to banks to meet those special liquidity demands created by the recent tensions. It's not intended to directly alter the stance of monetary policy. We do believe that it's working. It's having its intended effect of bolstering confidence in the banking system and thereby forestalling what might otherwise have been an abrupt and outsized tightening in financial conditions. So that's working. In terms of the distribution of reserves, we don't see ourselves as running into reserve shortages. We think that our program of allowing our balance sheet to run off predictably and passively is working. And of course, we're always prepared to change that if that changes, but we don't see any evidence that that's changed.
Hi, Chair. Katerina Saraiva with Bloomberg News. The minutes of the January-February meeting, the last meeting, indicate that you discussed the possibility of runs on non-bank financial institutions and the impact of large unrealized losses on bank portfolios. Can you talk a little bit more about that discussion, kind of what was talked about in light of that? And then why didn't the Fed do anything about that at that point to ultimately prevent, what happened this month?
I mean, to be honest, I don't recall the specifics of that. It's quite an interesting 7 weeks, but I will tell you though that there have been presentations about interest rate risk. I mean, it's been in all the newspapers. It's not a surprise that there are institutions that have had unhedged long positions in long duration securities that have lost value as longer term rates have gone up due to our rate increases. So that's not a surprise. I think, as you know, as it is now on the public record, the supervisory team was apparently very much engaged with the bank repeatedly and was escalating, but nonetheless what happened. And so that's really the purpose of one way to think about the review that Vice Chair Barr is conducting, is to try to understand how that happened and try to understand how we can do better and what policies we need to change. I mean, one thing is the speed of I'll come back to that, the speed of the run. It's very different from what we've seen in the past, and it does kind of suggest that there's a need for possible regulatory and supervisory changes, just because supervision and regulation need to keep up with what's happening in the world.
Can you confirm whether or not the board knew about these escalations by the examiners in San Francisco?
I will have to come back to you on that. Yeah, I don't know.
Simon Urbanovich with The Economist. Thank you very much. Chair Powell, you've stated twice today that all depositors' savings in the banking system are safe. Are you saying that de facto deposit insurance covers all savings? Shouldn't Congress have a say in that? And just by way of example, if a bank with less than $1 billion in assets failed, are you promising to bail out all of its
Sorry to cut you guys off, but I re-enter short on ETH.
I'm not saying anything more than I'm saying. So, but what I'm saying is you've seen that we have the tools to protect depositors when there's a threat of serious harm to the economy or to the financial system, and we're prepared to use those tools. And I think depositors should assume that their deposits are safe.
Go to Greg Robb.
Yep, everyone, we're short on ETH.
Thank you, Chair Powell.
ETH short trigger. We'll see what
I was
happens.
wondering if you could give us a little bit more color. You gave just a little bit of color. You said during the first week of the Silicon Valley weekend, you said the question you guys asked was, how did this happen when you saw Silicon Valley Bank? So I was wondering if you could go to the Credit Suisse merger. I mean, wasn't that the big gorilla in the room? Didn't you breathe a sigh of relief when that merger happened? Thanks.
Sure. So, that was really the Swiss government. We, of course, were following it over the course of the weekend, and we were engaged with their authorities in the way that you would expect, all the ways that you would expect. It seems to have been a positive outcome in the sense that the transaction was agreed to, and it has been, the markets have accepted it, and it seems to have gone well, and I think there was a concern that it might not go well. So coming into the middle of this week, yes, I would say that has gone well. So far.
Nicole.
Hi, thank you, Chair Powell. Nicole Goodkind with CNN Business. In the summary of economic projections, the FOMC sees the unemployment rate increasing to 4.5% this year. I'm wondering how you anticipate preventing this from snowballing while using the admittedly blunt tools at your disposal.
So that's an estimate of what will happen as demand slows and as conditions soften in the labor market. And it's a highly uncertain estimate. And there's really, we have to bring inflation down to 2%. The costs of bringing it down, there are real costs to bring it down to 2%, but the costs of failing are much higher. And if you read your history, as I'm sure you have, you can see that if the central bank doesn't get inflation back in place, make sure that inflation expectations remain anchored, you can have a long series of years where inflation is high and volatile, and it's hard to invest capital. It's hard for an economy to perform well, and we're looking to avoid that, and and to get back to where we need to be, back to where we were for a quarter century, and get there as quickly as we can.
But I guess the question is, historically, it's hard to.
Historically, it's been hard to contain unemployment, and the question is, do you worry about some sort of snowball effect, and how do you factor that into your projections and your thoughts?
Well, it depends on whether so recessions tend to be nonlinear, and so they're very hard to model. The models all work in a kind of linear way. If you have more of this, you get more of that. But when a recession happens, the reactions tend to be nonlinear, and that's so we don't know whether that'll happen this time. We don't know. If so, we don't know how significant it will be. And so, we're very focused on getting inflation down, because we know in the longer run that is the thing that will most benefit the people we serve. That's how we can have we've had very strong labor markets through these long expansions that we've had. 4 of the 5 longest, or 3 of the 4 longest expansions in U.S. history have been really since the high inflation period. And the reason was inflation wasn't forcing the central bank to come in and stop an incipient or an expansion. You can have very, very long expansions without high inflation, and we had several of those, and they're very good for people. You see late in an expansion, you see low unemployment, you see the benefits of wages going to people at the lower end of the wage spectrum. It's just a place that we should try to get back to.
Hi, Chair Powell. Jean Young with Market News. I just wanted to ask, with all the events of the past 2 weeks, do you still see a possibility of a soft landing for the U.S. economy?
It's too early to say really whether these events have had much of an effect. It's hard for me to see how they would have helped the possibility, but I guess I would just say it's too early to say whether there really have been changes in that. The question will be how long this period is sustained. The longer it's sustained, then the greater will be the likely declines in or tightening in credit standards, credit availability. So we'll just have to see. I do still think, though, that there's a pathway to that. I think that pathway still exists, and we're certainly trying to find it.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Just wondering how many financial institutions have been issued matters requiring attention or matters requiring immediate attention citations at this point?
How many? I don't know. But those are serious. Those are serious regulatory, particularly immediate attention. And I guess there were 6 of them. So.
And getting to the seriousness of it, how are you going to ensure that banks comply with these citations, take them seriously? How will you enforce them?
That is a great question and is right in the heart of what the review will be doing under Vice Chair Barr's leadership. So I think that's what you think about. What can we do to make sure? But again, that's not for me to answer today.
So you don't have specific thoughts on that?
Well, I see. If I did, I wouldn't share them because I really, this review's going on, and I want nothing other than us to find out what happened and why, figure out what we can do to do better, and then implement those changes. That's all I want. It's for me to be giving you my half-formed or partially informed thoughts. It just isn't appropriate. There's a real serious review going on with people from all over the Federal Reserve System who are not connected to this, to this work, not connected to this bank, and under again Vice Chair Barr's leadership, and I'm confident that it will produce a satisfactory result.
Okay, we'll go to Jennifer for the last question.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. Curious, how do you view financial conditions right now? If credit becomes expensive enough, choking off growth, as you said you're watching for, would that situation warrant a rate cut? What situation would warrant a rate cut? And have the bank failures prompted any discussion around changing the implementation of the balance sheet runoff? Thank you.
So we haven't really talked about changing the balance sheet implementation. That's not something we've discussed yet. As I mentioned, we're always willing to change that if we conclude that it's appropriate, but we're really not seeing any signs there. Sorry, then the question before that was, just give me a...
Curious how you view financial conditions now, and if credit
okay.
were to tighten enough, if that would prompt a rate cut.
So financial conditions seem to have tightened, and probably by more than the traditional indexes say, because the traditional indexes are focused a lot on rates and equities, and they don't necessarily capture lending conditions. So we think that, though. So there are other measures which if they're focused on, bank lending conditions and things like that, they show some more tightening. The question for us, though, is how significant will that be, and how, what will be the extent of it, and what will be the duration of it, and then once you know that. There's a fair amount of research about how that, with broad uncertainty bands, how that works its way into the economy over what period of time. And so, so we'll be looking to see the first part of that, like how serious is this, and how does it look like it's going to be sustained? And if it is, it could easily have a significant macroeconomic effect, and we would factor that into our policy decisions. I mentioned with rate cuts, rate cuts are not in our base case, so that's all I have to say. So,
thank you.
Thank you very much.
All right, everyone. Mr. Powell, Chair Powell, has spoken. Let's get the music up again. What do you guys think? What do you guys think of what's going on here? Let's see. 58% of you said pump. 48% said dump. 43% said dump. So, yeah. We got a little bit more of, finally, I guess, these moves that when Jerome Powell speaks, it definitely does trigger some market action. Doesn't mean these decisions are, how do I say this, drastic, but it could start a snowball effect, right? Like I said, we do have a possible reversal. All right, we're in our ETH short. If you guys haven't been paying attention, but we're short off of this pivot here. All right, so we're currently sitting above it, but we'll have to wait and see what happens here. Hopefully we'll get a confirmation of a larger move soon. Hopefully this is the beginning. We'll have to see what happens. You can see Jerome Powell is willing to hold out on interest rate hikes for the time, well, not for the time being, for the near future, but he's definitely opening to continuing those. So I guess we'll have to see. Maybe we'll get a couple, maybe a month or two of a pause to see how things react. But unfortunately, these things take time to show the effects of the economy. So we'll have to see how the Fed goes ahead and approaches the Fed rate hikes in the near future. I believe he said he was going to do one more. But besides that, we'll have to see what happens. If that's truly the case, we'll see how the dollar behaves. We'll see how Bitcoin behaves. But yeah. All right, guys, we've been going here on for 2 hours here. We got a confirmation of a move. Hopefully, we'll continue to the downside. Like I said, I wasn't supposed to be here today, but we're going to be here tomorrow. I'm going to go ahead and cut it, guys, just because, like I said, we've been here for going on for a while. We watched the entirety of the action. And we'll definitely get a larger... we'll definitely get an answer to what the market wants to do here soon. So, I do appreciate you guys. Thank you guys for hanging out. I definitely, let's see. This could time up perfectly with the halvening. Definitely, Joe, definitely. Go ahead and end that poll. But thank you guys so much. I really do appreciate it. Sooner or later, we need home run for profits. So many each stop losses. So yeah, don't worry, Jeff Jefferson. We will. We'll get that one. We'll get it soon. Thanks, Johnny. Have a good day. Thank you so much, Mies. I do appreciate it. Everyone, thank you guys so much for hanging out with me, enjoying the fun, chaotic times. It's always fun watching these. So we'll see what happens. I'll see you guys tomorrow. Same time, 1 o'clock Eastern Standard Time. So I really do appreciate it. You guys, be good, be safe, trade safe. Don't be stupid. Don't make stupid decisions. All right. We're going to go ahead and do the thing. But I wonder, can I expand this without having my green screen be exposed? Yeah, cool. All right, I'm going to do the thing. I'm going to stare into your guys' soul. Are you guys ready? What I'm going to do, I'm just going to drag this out is... Big me. Bye-bye.